Australian property prices are starting to diverge. Yes, the median property price in Australia is continuing to rise, but that does not mean that prices are rising everywhere. Today, I'm going to break down exactly where property prices are rising the most and where they're not, which areas you should be looking to invest in, and which areas you might want to avoid. Let's go. Australian home values have risen for a 14th consecutive month. That's right, 14 months in a row, prices have continued to rise in Australia and defied expectations of a slower rise as demand continues to outstrip supply despite the ongoing cost of living pressures and high interest rates. Now, that's a very important point. Yes, there are cost of living pressures. Yes, some people are struggling. Yes, interest rates are at the highest they've been at for over a decade, and yet property prices continue to rise in value. Home values rose by 0.6% across the country in March, according to CoreLogic's Home Value Index. But as I said earlier, they haven't risen everywhere, and I'll break it down for you in just a moment. That helped accelerate the quarterly pace of growth from 1.4% in the December 2023 quarter to 1.6% in the first 3 months of the year. So what that means is that not only are property prices rising, the rate of growth is actually getting faster. But it was just at the end of last year when we started seeing headlines like this talking about how property prices are starting to plateau. So many so-called experts said that property prices would probably fall or struggle in 2024. And yet I came out and said that from the start of 2024, a major property boom would begin in multiple markets around the country. I said it wouldn't be nationwide, it would be focused on certain key markets. And that's exactly what the data is starting to show just 3 months into 2024. So here we have the CoreLogic RP Data Daily Home Value Index, the monthly values as at the 31st of March 2024. And if we look at Sydney for the last month, all dwellings, the median price only rose by 0.3%. Essentially, the market is flat in Sydney, but this is on a Sydney-wide basis. If you break it down, there are certain markets that are still really, really hot. For example, in the inner west of Sydney, but then certain pockets, for example, around the North Shore of Sydney are flat. But when you look at Sydney-wide, property prices were flat last month, but for the last 12 months, they've risen nearly 10%. Melbourne property prices, 0% change, as flat can be. Even for the last 12 months, prices have only risen 3.2%, which is actually less than inflation. So the Melbourne market, certainly not doing a lot. But then look at Brisbane last month, 1.2% growth, and for the year to date, 15.1% growth. Adelaide, 1.4% last month, year to date, 13.3%. And Perth, last month, 1.9% growth, and for the year to date, it's 19.8% growth. So you can see that based on this data, which is just focusing on capital cities, there are really only 3 markets that are rising significantly, and those are the markets that are driving the property price boom right now. Now, does that mean that you should only focus on these 3 capital city markets? Well, no, because there are markets within markets, or there are multiple regional markets that are doing really well, and even within those stronger capital cities, there are some areas that are flat and even struggling, and some areas that are doing really, really well. So all I'm sharing with you is the macro level data, and then we need to break it down to find the best areas to invest in. But when you start with this level of data, it certainly shows you that it doesn't make a lot of sense to be buying a house in Melbourne or a house in Sydney or even a house in Canberra and spending $1 million, $2 million, whatever the case happens to be, and expecting some significant capital growth. The data clearly shows that you'd be better off looking at areas that are a lot cheaper, which is going to lower your risk. These areas also have much better rental returns, which means you won't be out of pocket as much each and every month, and it looks like the growth is going to be sustainable. Why do I say that? 2 reasons. Number 1, there are many people who are thinking of buying a property but are just sitting on the sidelines waiting for a sign that everything is going to be okay. Rate fears force home buyers to delay plans. Worries about further interest rate rises and lack of mortgage relief are prompting some home buyers and investors to delay purchasing over the next 6 months, a Westpac survey has found. However, the majority are still intent on buying over the medium term once interest rates are cut and cost of living pressures abate, property insiders say. So what this means is that even though property prices are rising, there's a whole new wave of demand about to enter the market. I expect that wave of demand will come into the market from the second half of this year, and that's only going to further force property prices higher, because we already know that in multiple markets around the country there aren't enough properties for the number of people who want to buy. And now if you add a fresh new wave of demand, you're adding several more people who want to buy, but we're not increasing supply. I'll come back to that in just a moment. What do you think is going to happen? Property prices will continue to rise and the rate of price growth will accelerate. And if we look at the supply side of things, it actually paints quite a disastrous picture. Let's have a look at some data from the Australian Bureau of Statistics, specifically Building Approvals Australia. What we can see here is that as at the end of February, the seasonally adjusted estimate showed us that the total dwellings approved fell 1.9% to 12,520. The value of new residential building fell 19.1% to 5.79 billion. The value of non-residential building fell 16.0% to 4.09 billion. Now remember, we're talking about the value of new approvals falling at a time when property prices are rising. Okay, so this is actually quite disastrous. So we're actually building fewer and fewer homes at a time when our population is growing faster than it ever has. But in these lower priced markets, so markets under $1 million and certainly under $800,000, you're going to see sustained price growth. Why? Because at those prices, it's not profitable for builders to be able to build at a large scale. So when we see that new wave of demand that's set to come in, I expect from the second half of this year, once we have certainty about the tax cuts, once we have certainty about interest rate cuts, you're going to see so many people want to buy properties in these lower price markets as well as in the higher price markets. But in those lower price markets, the areas that are doing really well right now, the problem is that property prices are too low for builders to be able to go and increase supply profitably. That means that they just can't build more properties until property prices rise, which means that, put simply, the areas that are leading the property price boom right now in terms of capital cities or regional markets will, in my opinion, continue to lead the property boom for quite some time yet. The price growth will be sustainable. So while so many other people are sitting on the sidelines, if you're someone who can afford to buy an investment property, if your budget is somewhere between, say, $500 to about $850,000, it certainly seems like when you look at the data, the longer you wait to get in, the more capital growth you're going to miss out on. And if you want help on how to find the right areas to invest in, check out the link below to get totally for free the digital version and audio version of my book. Otherwise, I'll see you next time.